Hey there, everybody. Hope you're having an incredible Tuesday. Welcome to SRT Live with me, your host, Sean Richard, here at Guaranteed Rate with the Sean Richard Mortgage Team. Thank you for your patience. Had some technical difficulties getting the stream up and running today. So I am here, and man, we've got a lot of information to go over. I'm going to try and go over it relatively quickly so that way you can absorb it and take it out to your clients and share with your sphere of influence so that way you can be the expert on the real estate market. So let's dive right in. Lots to cover today. Let me go ahead and pull up the group, the Facebook group here. And all right, there we go. So yeah, so lots going on today. We've got some commentary from the Fed's Bullard, and he's come out and had some pretty hawkish or bold remarks. So we'll jump into that. But let's talk about some of the data that we've got today and yesterday. So we got March's housing starts and building permits. And why this is important is because this is indicative of where the market is heading going forward. So for March, we actually saw a month over month increase in housing starts of 0.3%. But we need to really peel that back a little bit to gather the right information. So we want to look at just single family residences, and single family residences housing starts are down 1.7%, and that's a big deal. That shows the slowing of the building process, and I think all of us realize that builders are struggling to put homes in a quick fashion or to meet demand at the speed that they need to meet demand, and so that's coming through in some of these numbers. Building permits, we also saw an increase month over month overall, 0.4% increase. But again, if we break that down to single family, we actually saw a decrease of 4.8%. And again, the builders they're authorizing these starts to occur, but they're not actually starting in a timely fashion. I'll kind of talk about that again here in a little bit. Last week's numbers, we had inflation last week. We got the CPI and PPI. So CPI is the consumer price index, inflation at the consumer level, and we saw PPI, producer price index, which is inflation at the producer or manufacturer level. And so overall, the headline numbers were pretty outrageous. Last month for CPI, we had a 0.8 increase month over month. This month, we got a 1.2% increase. Pretty flashy numbers. Year over year, last month was 7.9%. This month, we got 8.4%, the highest numbers that we've seen as an economy since the beginning of the 1980s. Now, this is the overall reading, or the headline reading. But if we strip out food and energy, which, to be fair, food and energy, the reason we would strip that out is because we have, the Fed has less control over those numbers. When the Fed is looking at implementing monetary policy, they want to look at the factors that they have more control over. Food and energy, two of those factors that they have less control over. So if we look at the core inflation readings, which is without food and energy, we actually saw a decrease in month over month inflation at the consumer level. Went from 0.5% to 0.3%, which is why the market didn't necessarily overreact at that gaudy 8.5% or 8.4% number. And then on the core reading for year over year numbers, we went from 6.4% to 6.5%. So just a small increase in the core inflationary numbers year over year, but a slight decrease month over month. So hopefully, the March report took into consideration the spike in energy prices associated with the Ukraine war. And so hopefully we're starting to see inflation peak and stabilize, and the Fed is working on putting some monetary policy into place to bring that down. Last week, we also got unemployment claims on Thursday, as we always do. We got initial claims, people filing for unemployment for the first time, and we got continuing claims, people renewing their unemployment benefits. So initial claims, we went from 167,000, which was a post-pandemic low, to 185,000, still very low numbers on unemployment claims. So speaking to very healthy employment market, we've got very low unemployment numbers. Continuing claims actually dropped by about 50,000 from 1.523 million to 1.475 million. So a decrease in continuing claims. So we're seeing more people cycle off unemployment as we have companies across the entire country hiring at a feverish pace, it seems like. I know you drive around, you see hiring signs everywhere at retail locations. You've got high levels of job openings across the board at companies. So we've got low levels of employment and high levels of job openings, making it companies are retaining their employees longer in those scenarios. Looking ahead to the rest of this week, we've got existing home sales coming up tomorrow, and that's going to really give us some insight as to the health and pulse of our housing market. Now, in this market where we've got extremely low inventory, we can expect existing home sales to potentially be on the low side because we can't sell what we don't have. So if inventory is continuing to shrink, then we're going to see existing home sale numbers continue to shrink as well. So let's watch out for that tomorrow. And then on Thursday, we get jobless claims as we always do. So we'll cover that in next week's market update. All right, so let's get to some of the fun stuff. What are we looking at? What are we watching for as we head forward? So the real headline here is that the bond market doesn't appear to be trusting of the Fed. And I say that because normally when we are in a position for the Fed to increase the Fed funds rate, to hike rates, as we've heard, the mortgage bond market typically likes that. And quick reminder, the mortgage bond market is what directly impacts interest rates. As mortgage bond prices go up, interest rates come down, or vice versa. As bond prices come down, interest rates go up. And so they have an inverse relationship. Normally, when Fed is hiking the interest rate, the Fed funds rate, we see mortgage bond prices go up. Lately, though, they have continued to decline, which is pushing interest rates higher. And that tells us that the bond market does not trust the Fed. The Fed appears to be scrambling because for the longest time, they had the commentary that inflation was transitory. They didn't take action. And now they're scrambling and looking at some potentially massive rate hikes over the course of this year. To that point, the Fed chair or one of the Fed members, Bullard, and I apologize, I don't have his, I want to say Ray Bullard. Yeah, let's see, Lieutenant Bullard. Yeah, James Bullard, that's it, James Bullard. He has come out and said he wants to see the Fed funds rate up at 3.5 by the end of the year. Now, what does that mean? Currently, the Fed funds rate is at 0.25%, which means the Fed would have to raise by at least 0.5% at every remaining meeting this year. And that could have a pretty significant impact on the economy and where mortgage bonds and interest rates head. So we need to keep an eye out for that. The Fed's next meeting is in May. We want to see what they do there. Pretty good chance that we're going to see 0.5% increase to the Fed funds rate. And again, ideally, that's designed to curb inflation, which would hopefully bring interest rates down. We also had some additional indicators come out from the World Bank and the IMF about the slowing global economy. And so you've heard me talk about potential recession. You've probably seen it in the media. And we got additional indicators recently from the World Bank and the IMF. So the World Bank came out and they updated their global economic forecast from global growth from 4.1% to 3.2%. So global growth slowing. And so we need to keep an eye on that. If they continue to revise those lower, then we could find ourselves in a global recession, not just a US recession. Let's see, I talked about Bullard. If we do see that significant increase in Fed funds rate over the course of this year, that would undoubtedly push us headfirst into recession, which is where I think that I personally think we're heading anyways. So we just need to keep an eye on that, see what we get out of the Fed come May, and then again they're meeting in June. You know, and the recession, obviously there's a lot of negatives that come with the recession. It is, you know, there's a lot of downside to the economy. But if you're a homeowner, if you're a home buyer, there are definitely some positives as well. Typically during a recession, home prices continue to rise, but during a recession, interest rates tend to decline. So all of you buying homes right now, you'll have an opportunity to potentially refinance to reduce your mortgage payment. All of you who are in your homes and are looking to maybe benefit from the equity that you've built over the last number of years, that would be an opportunity to do that as well. So there are some positives that come out of a recession. Lastly, I've kind of already talked about this, but the backlog for builders is growing. I received a stat from MBS Highway this morning that the authorizations to start, or I guess authorizations but not started. So builders have authorized a home to start but have not started, increased month over month by 15%. We've got builders that are giving the green light to go ahead and start construction, but because of the delays in starting construction, whether it's lack of workers, lack of supplies and materials, inability to get timely permits, all of that is backlogged right now. Completions, home completions, month over month are down 6%, and year over year are down 4%. So we've got starts slowing down, and we've got completions that are down a little bit as well. So the builder backlog is real, and they're working very hard to try and put more homes up, but they're running into some challenge. So we're still seeing a lot of labor shortages, supply chain issues that are impacting builders. And those are all part of the reason that home prices are sustainable at these growth levels. We have the very low supply that is not currently getting better, and we have very high demand that isn't waning either. So we have that equals price stability for real estate. So again, home prices going to push higher. If you're a homeowner, you're excited because your equity is going to continue to grow. If you're a home buyer, that does mean that buying today is better than buying 6 months from now. You know, they say, when's the best time to plant a tree? Two best times are 20 years ago and today. So same thing with home buying. If you have any questions whatsoever about the market or home buying, home refinancing, don't hesitate to hit me up here. Ask your questions in the comments below, and I'd be happy to answer them. But until next week, have an incredible rest of your week. And thank you so much for joining me on this edition of SRT Live and your real estate market update. Take care and have an incredible week.